Want to know all the different investment opportunities available to you? We got 42 types of investments for you, from simple to complex. This part 1 covers 5 simple investments. Subscribe for our next parts. From all these investments, maybe you want to find that one perfect investment you like. Or maybe you want to invest a small amount in multiple places every month and watch it grow. In this video, we're going to cover it all. We'll talk about the investments everyone knows, and a few powerful ones that only some people know about. So, let's get started. Investment 1. Cash savings. First up, the most basic starting point is cash savings. This is the primary step in any financial journey. Now, to be clear, this isn't your daily spending money. This is the cash you put aside with one simple rule: you do not spend it. The pros are obvious. It's incredibly easy. You can literally start doing it right now. It's 100% in your control, and it feels completely safe because it's tangible money you can see and hold. But the cons are significant. It generates zero income. No interest, no ROI. It also takes strong financial discipline. It's just sitting there, tempting you to spend it. A quick tip: if you struggle with financial discipline, move your cash savings into a separate bank account that you don't look at often. Or give it to a trustable person who is really good at financial discipline. Out of sight, out of mind. Investment 2. P2P, peer-to-peer lending. Let's talk about one you might not know: P2P, or peer-to-peer lending. Think of this as an online platform that lets you become a bank. You lend your money directly to other individuals who are looking for a loan. There are many RBI-regulated platforms that manage this entire process. Here are the pros. The potential returns are very high. You can earn interest up to 30% or even 36% per year on some platforms. You get your money back in EMI form, a little bit of principal and interest every month. You can choose your borrowers based on their financial history and diversify by lending small amounts to many different people. Now the cons. This is the number one rule of investing. The more interest, the more risk. Defaults do happen. People with bad CIBIL scores might not pay you back, and you could lose your money. It's all digital, so you have no personal contact with the borrower. The platform's collection teams are your only backup. Investment 3. Online or digital gold. Many of us buy gold as ornaments, which is a great traditional investment. But if you don't have a large amount for a chain or a coin, you can buy digital gold. This is exactly what it sounds like. You buy 24-carat pure gold, and it's stored safely for you in a digital vault. The pros are fantastic. It's incredibly easy to buy and sell, 24/7, right from your phone. You can buy for as little as 10 rupees. It's one of the safest ways to own gold. There's no risk of theft, and if you accumulate enough, you can even convert your digital gold into physical coins or bars. The only real con is, it's a slow investment. The returns are based purely on the market price of gold, which doesn't always move quickly. But as a safe investment to hold value, it's excellent. Investment 4. SIPs. Okay, number 4 is SIPs, or systematic investment plans. You've probably heard of these, and they are one of the best ways to build wealth. Now, an important clarification. SIPs are not an investment itself. It's a method of investing. It's an automatic instruction you give to your bank to invest a fixed amount of money, say 5,000 rupees, every single month into an investment, usually a mutual fund. The pros are powerful. It's the easiest way to start investing in the stock market. It builds a habit of financial discipline. It's a one-time setup. You get the benefit of compound interest and rupee cost averaging, which is a fancy way of saying you reduce your risk by buying at different price points. The cons are, it can take a long time to get good returns. This is not a get-rich-quick scheme. It's a get-rich-slow plan. You can only select the fund, not the individual stocks inside it. You have to trust the fund manager's expertise.
Investment 5. Chit funds. Chit funds are a very old and popular form of finance in India, acting as both a savings plan and a loan, all in one. It's quite simple. A group of people, let's say 20, agree to contribute a fixed amount every month. For example, 5,000 rupees each. That means every month the group collects a total pot of 1 lakh rupees. Then, that 1 lakh pot is given to one member of the group, either by a lottery or an auction. This process repeats every month until every single member has received the pot once. The pros. It's a form of forced savings that builds discipline. It gives you access to a large, interest-free or very low-cost personal loan when it's your turn. The cons are very serious. The risk of fraud is high if you join an unregistered or informal chit fund. There's a risk of defaulting members, people who take the pot early and then stop paying. And if you're the one who takes the money in the very first month, it can end up being a very expensive loan. Investment 6. Government bonds. And finally, number 6. Government bonds. A government bond is basically you lending your money directly to the government. This could be for a few years or even 30 years. The government issues these bonds to raise money for public projects, like building new roads, schools, and hospitals. In return, the government pays you a fixed interest regularly and then pays your entire original principal amount back at the end of the bond period. The pros. This is one of the safest investments on the planet. It's backed by the full faith and credit of the government. It provides a completely predictable, stable income stream. The cons. Because it's so safe, the interest rate is usually low, often just enough to beat inflation. And sometimes it can be hard to sell the bond before its maturity date if you need the cash early.
And there you have it, 6 different investment opportunities of 42 investment types, from the super simple cash in your drawer to the high-tech world of P2P lending. We covered the well-known, like bonds, and the less-known, like SIPs. The real power isn't in picking just one. It's about knowing your options, understanding the risks, and building a plan that works for you. Maybe that's putting a small amount in several of these, just like we said at the start. Which one of these are you most interested in? Or are you already investing in one? Let me know in the comments below. Thanks for watching. If this video helps you, and if you want to know the next investment types, please hit that like button and subscribe for more.